Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kessling, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Welcome, ladies and gents, to the Absolute Return Podcast. On today's show, we welcome special guest, ClimateRock CEO Per Regnarsson. ClimateRock is a special purpose acquisition company that plans to acquire strategic renewable assets and enabling technologies with large decarbonization potential and strong financial history and prospects. On the show, Per discusses what specific types of opportunities the SPAC is looking at, his thoughts on the current market environment, the outlook for sustainable investing, key segments of the sustainability sector that investors should have on their radar, and more. So with no further ado, here's our show on renewable energy investing with ClimateRock CEO Per Regnarsson. Welcoming Per Regnarsson from ClimateRock all the way from London, UK. How are you, Per? Thank you for coming on the show so late tonight.
Yeah, thank you. Thanks for having me on the show. I'm delighted and good time of the day.
Yeah, and I hear it's very hot in London as it is in North America these days, which plays very well to what you're up to at ClimateRock in terms of sustainable investing, ESG, and things of that nature. But prior to our discussion on what you're up to at ClimateRock, I was wondering if we could talk a little bit about your early career background, including how you initially got into finance and your experience at various Wall Street firms across the pond.
Yeah, thank you. No, I'm a Danish national. So I started my banking career back in the 80s in Denmark. I spent about a year in New York in 1990. A lot of things happening 89, 90 in the financial sector, and I really got the appetite to not work out of Copenhagen in the long run, but going back to one of the big financial centers. And so coming back to Copenhagen and then later moving to London in 94 with the objective of being in one of the big financial centers and in finance. And it was probably, I started my career as an apprentice, so it wasn't sort of a late decision for me to go into banking. I kind of started there. And I grew up in an environment where in many ways things are only sort of appearing to you in hindsight, what you learned and what you benefited from. But having spent then the sort of early 90s to sort of mid-noughties in the city of London with a few stints in New York at various institutions, it became, you could say, a career that was focused on the industries that are relevant to renewable energy today. So energy, infrastructure, transportation, engineering companies. So late-stage technology development, but more the deployment of engineering technologies. And on the other side, on the finance side, it was about how do you fund these things? So different structures from everything from common equity to super senior debt, public-private structures, different types of investors and different deals. So I think those years formed certainly my let's call it approach to going into renewable energy back in 2006 and 7, bringing some of the structuring experience from the financial markets, bringing the industry experience from some of the sectors that I covered over the years. And I would probably sort of point to 4 years at Moody's where I was in a position to dig deep into sectors as a research analyst. But I would also go back to my sort of early adulthood in Denmark. You're working with and beating some individuals that were quite early movers in talking about greenhouse gas effects and talking about how you need to save your energy, and later on in life learning from the Danish experience of being an early mover into renewable energy and clean tech and energy efficiency.
Certainly renewable energy being a huge topic in Europe these days, just given what's going on with sourcing of natural gas from Russia, obviously highly controversial there. And then even Germany now refiring up those coal-fired power plants, which is obviously a huge concern from a pollution and climate change perspective. But That's a whole nother discussion. Now, transitioning from Wall Street to entrepreneurship, you made that move a while back. So can you describe how this transition was? And was it your goal to always work, within sustainability, ESG, and really trying to improve life for humans?
I think it came due to the background with the energy and transport markets and infrastructure and finance. It was clear to me that it was a sector that it appealed to me. It made sense. It also makes logical sense. You try and do something for the better of society. But I didn't. It wasn't something I planned 5 years earlier. So there's been a couple of waves when it comes to clean tech and renewables over the years, and Europe did start quite early. In fact, so did parts of the US as well, if you go back to the 90s. But I probably benefited from having a very strong relationship to people in the Scandinavian environment. Either they were involved in hydroelectric power in Norway and Sweden and Finland, or they were involved in wind energy in Denmark that migrated into other countries, or Norway was also one of the early movers in solar energy, with a lot of production later moving to Germany, only to be taken over by China eventually. So having seen how the trends of moving development and production and innovation from country to country, I think there was a lot of the things in the supply chain, in the engineering sector, as well as in the energy market that appealed to me. And I knew I had the background in structured finance to actually to help deliver something. And I remember when I set up my first shop, it was really because I probably reached the point where I wanted to try out doing something without a safety net, so to speak, having formed divisions within a few banks and built them into some self-sustainable sectors of the bank, and then trying out how it would be to do your own thing. I always had the opinion that I needed to meet somebody with the idea, because I wasn't the idea generator, but I could help to form and structure and move an idea forward. So that kind of the role I took in entrepreneurship.
Yeah, really taking on the execution aspect. That makes sense given your background. Is there any other advantages that your background in capital markets has provided you as you've transitioned to entrepreneurship and sustainability with ClimateRock?
I think it's an interesting question, actually. I think it's when you look at what you bring to the table, entrepreneurs are often seen as being, have no risk aversity, right? So it's all about the idea and speaking of the idea and the vision, which is great. But when you then bring in other people's money, then there's an element of it where you need to look at the risk profile and manage the risk, and trying to balance the growth and the ambitions and the excitement with that execution factor. So I think actually having spent years in financial risk management helps you to build a platform perhaps better for an entrepreneurial business. And I think that's probably one of the things actually.
Now, your current project, ClimateRock, is a special purpose acquisition company. It went public in New York in May of this year. What initially drew you to the blank check vehicle? They've been quite popular as of late.
Well, first of all, whenever I come across projects or products in capital markets, I'm always curious, and that's down to my upbringing within investment banks like JP Morgan, Merrill Lynch, after my stint at Moody's, and sometimes product innovation in the financial service sector has a bad connotation, but there's also a lot of positive innovation, and with the blank check companies, I felt it was an opportunity when you were looking to set up investment structure where you knew you're going to make acquisitions to grow that investment company, and where if you look to other structures like REITs in the property market or yieldcos in renewable energy markets, the SPAC structure appealed to me because it allowed you to be more, let's call it heterogeneous on the portfolio, or even consider a more vertically integrated business model than just buying assets, and which makes you more or less a fund manager, right? And I felt the opportunity was to create something, given where the market is going, that was a bit more vertically integrated as a business where that could involve development and operation and also services. So different income stream that will contribute to a growth story that will also see you through the cycles.
And now, a word from our sponsor, Accelerate, one of Canada's most innovative and fastest-growing alternative investment solution providers, with a suite of institutional caliber alternative ETFs for investors seeking diversification and long-term performance. The Accelerate Arbitrage Fund, symbol ARB on the TSX, is the world's first SPAC-focused ETF with a diversified portfolio of SPAC and merger arbitrage opportunities in an easy-to-use, low-cost ETF. The Accelerate Arbitrage Fund ETF trades under the symbol ARB on the Toronto Stock Exchange. Find out more at accelerateshares.com. In terms of ClimateRock's mandate or focus area, the sustainability, clean tech, ESG sectors, there's a myriad of different segments within that, different opportunities. What specific opportunities are you looking for within the umbrella of sustainability, clean tech? And in addition, what are some characteristics of the ideal target company?
Well, I think we have a global market nowadays. I think a few years ago, Stanley Fink from BlackRock came out saying that renewables have gone mainstream, and I think that's very much the case. But there's still different bottlenecks and different development stages in different regions of the world that are learning from each other. Europe is definitely a very mature renewable energy market. And until we had the issue with energy security related to Ukraine and Russia and the global gas markets and energy markets in general, it was also seen as being almost like a market where it as an institutional investor, did it make any sense to invest in German renewables, for instance? That has completely changed since we started our process. But even so, the maturity of the market also means that you have companies that are going back perhaps 20 years, founded by individuals that are either looking for succession or simply looking for an exit or looking to go from being regional to being global. So that offers many acquisition opportunities of established players. And then when you think about the nature of the IPO market these days, probably a SPAC structure, certainly what we're finding after listing, having raised the capital for a strategy that we and others think makes sense. There's a lot of opportunities, as I just described, amongst these type of companies. Ownership structures looking for what's next, looking to diversify from one sector to another within renewables. So that's probably where you will see us being active.
Yeah, no doubt you've been very active lately in terms of your search for the ideal company to merge with, the SPAC. I was wondering, what are your thoughts on the current market environment? Obviously, it seems highly competitive, particularly in SPACs. In addition, the wider macroeconomic environment, rising interest rates, volatile equity markets, tougher financing conditions. What are your thoughts on how things are looking from your perspective?
Well, I think you're absolutely right. The macros are a bit uncertain, to say the least. The trends with interest rates and also in terms of the perception of SPACs in the market and the recent activity in SPAC markets when it comes to de-SPACs. I think we're seeing a growing number of SPACs that are asking for extensions and in general, you could say that the market therefore is negative. Having said that, when it comes to an investment strategy within ESG, renewable energy, in a climate, if you want, where we're dealing with energy security and energy transition, I certainly see us, and the feedback I'm having is that we are in a good spot. Next to that, we decided to go for a relatively small IPO, you would say. So obviously 75, got close to 80 with the over-allotments. That also means that for us, redemption has less of an impact on any financing we want to achieve from the combination. And I think that's back to the idea of trying to de-risk what you're doing to improve success. And we set out to do this on the basis of creating an investment company for the long run, not just to create a de-SPAC and then wash our hands and walk away. Right. So I think we have created a structure where we believe execution is more likely to happen, and we have de-risked it by also looking at ways where we can come in with where we have additional source of funding. So we're not a tech SPAC. We're actually looking to buy cash flow, which allows us to combine small pipe to make up for redemptions with some debt finance that you can put on conservatively, but will be serviced by the cash flow of the underlying business. I think that's the way to create something that in the current environment is not necessarily too aggressive on the SPAC itself, but can certainly be an attractive growth stock going forward with multiple acquisition opportunities.
Yeah, it's really good insight in terms of the focus being on EBITDA, cash flow, perhaps free cash flow of the underlying asset that you're pursuing. And it seems like that's a very smart decision these days because those who invested or merged with target companies that didn't have revenue, EBITDA, profit for years and years out, those have certainly been suffering in the market with the downdraft in these hyper-growth, speculative entities. But with that, what other important characteristics of a SPAC sponsor do you think it's important to be successful in the current challenging market environment?
One of the things I find is that expect to prepare yourself for the SPAC IPO and the de-SPAC as if you were any other listed company. Don't think that you have too many loopholes, right? Just expect to deliver what you have to deliver so that you satisfy the regulators, because ultimately it's not about them, it's about the investors. You want to give them comfort that you are operating the business the way you should be operating the business. And then you just make sure that you are prepared to take the time and you staff your team with the right expertise to do it. So, I think, you asked before about, why the SPAC or why a blank check company. It was really just a matter of it made sense because it was a fast way to go to market. But even if it's fast, you still need to prepare yourself. You still need to deliver.
And with that said, you've been up and trading in the market, having your search. I'm sure you're evaluating a ton of opportunities out there. What are some key learnings thus far from your experience as a SPAC sponsor at ClimateRock?
Well, I think you're being, well, in terms of positive and negative, I think it's relatively positive from a market point of view. I don't see us having had any particular issues with investors coming into our SPAC. I think we're seeing some good appetite, hoping that others or some will actually come in a pipe to add to their stake. Keeping our name in the market also through discussions like this. And we actually think we have a story to tell. We think we have something that is slightly different. You don't see many pure play renewable energy SPACs. You see a lot of tech SPACs. You see mobility SPACs. You see diversification within the climate change market, which is great if we're trying to address climate change. But from our more selfish point of view, I think we have a carve out and with a team that's predominantly based in Europe, I also think that we are bringing perhaps assets from a different region to the NASDAQ market once we de-SPAC.
I did want to get into the weeds a bit on the sector that you focus on, sustainable investing, clean tech, renewable energy, because it entails so many different segments that have their own nuances, tailwinds, headwinds. For example, nuclear energy to me has always seemed like a no-brainer, but governments and regulators just can't seem to wrap their heads around it. And then you're seeing quite a bit of growth in wind and solar and battery technology. What are your thoughts on the segment that you're focused on? And, in terms of investment thesis, what do you think provides the best opportunities for investors within the sustainability and renewable energy segments?
Well, that's a good question, but it's also quite it probably requires, hopefully not too lengthy an answer, but there's certainly a lot of answers to that question. If you look at it from a capital markets point of view, there is a lot of capital pouring into renewable energy in the private market, not just in the public market. I would say certainly in the private market from pension funds and other investors that are sitting on the liquidity they have to place. And renewable energy is becoming a more and more important part of the real assets asset class, if you want. It used to be just real estate, then it became real estate infrastructure. Now it's also renewable energy, and everything has to be ESG compliant. So I think from a sustainable investment point of view, there's definitely a lot of interest, and we're beginning to see that more and more institutional investors are trying to balance their investments privately and publicly. But then you have the other trends across from investor point of view that they want to have more direct investments, and that favors perhaps private investments as opposed to being a listed company. So we see therefore that yields in renewable energy assets that are operating are compressing. Yields are getting lower because of the demand for these assets. We're seeing very well-known listed renewable infrastructure funds investing increasingly upstream, as we say, into construction assets, which in our view is not to get better yields. It's actually to get the yield they promised the investors in the first place by taking on more risk. So again, from our point of view, coming with a blank canvas, so to speak, we're basically looking to be in the market where we think that we're adding the most value. And that means that you probably want to have a balanced portfolio of development and operation, so you can actually be attractive to other investors looking to buy assets. And that means that you get the upside from the early stage development, and you're balancing that with the cash flow from operating assets. And then you combine that with some service income from being able to operate the same assets. So I think that's a long-term game. Short-term is to buy enough critical mass into an entity so that you can establish diversification by country, and establish some diversification also by stage of the assets. And that's what we're trying to focus on in the targets that we are looking at.
Now, in terms of some of the deals that you've looked at for competitors, who are you competing against to land, a merger target? Would it be infrastructure investment funds? Would it be publicly listed operating companies? Would it be pension funds? All of the above?
Well, the simple answer is all of the above. But I think I mentioned before, that the infrastructure funds are raising great number of money from the ultimate investors, the ultimate capital owners, whether it's pension funds or wealth management. And these funds are deploying them and helping to create this yield compression that I described. So you got to find the markets where, I think one of the opportunities is actually to go in and buy attractive assets that are undervalued based on some of the disruptions in the market. So I'm delighted that we have a team where we actually have a pretty good understanding of what's going on in local markets through many years of involvement, so that we can go below the auctions, go below the radar, and identify individuals where we think we have an opportunity to buy something that is slightly more attractive.
Now, you mentioned compressing yields. I always imagine it's some sort of spread to, say, the 5-year treasury or something of that nature. Have you seen it be correlated with financing rates, like in terms of compressing yields? Obviously, it's competitive, but has pricing come down at all as interest rates have ticked up this year?
Well, there is a bit of that, but I think the mega trend of demand for renewable energy, the energy security aspect, that means that the increased interest rates haven't hit the markets that hard yet. Longevity in terms of high interest rates is clearly going to affect the ability to put debt on these assets,
right? Which
in the mature markets are often 80% debt, 20% equity, right? So you have a high degree of leverage in these assets. Now, I think therefore you can, by not having all your exposure to operating assets in the debt market, that also allows you to have a slightly different risk profile. And then I think when it comes to correlation in general, I've been close to the yieldco markets for many years, and up until recently, the yieldcos were interestingly not correlating with the REITs. For instance, they were performing better than REITs. Probably as an example of property markets also suffering from COVID and the aspects that cause people commercial property markets to be slightly weaker. But I think the way I would look at yields in renewable energy, to me, has often been treating a German solar asset similar to a German Bund. So that's kind of the benchmark, and then you add risk from a sector and a country to the yields, right? And then they obviously trade at a premium to government bonds. So there's an element of what you're suggesting that I think rings true, but there's also nuances.
One interesting market dynamic that has played out over the past year that I'd be interested in hearing your thoughts on is, ESG was extremely popular for, say, 5 years up until about a year ago, just based on its outperformance, or they could say you can do good by doing good, invest with ESG companies and outperform. And that was the case, just given the long tech low exposure to energy, oil and gas, and things of that nature. However, that relationship has flipped, where there has been a massive outperformance of oil and gas and energy names, and ESG has underperformed, at least in the short term. Has there been any feedback from investors or change in attitudes, just given the recent outperformance of traditional energy and oil and gas vis-a-vis renewables and sustainable investments?
Well, I'm probably not that informed to give a detailed answer on it. I think what I'm seeing is that there is a lot of demand for renewable energy, and a lot of the investors looking at that sector are not allowed to invest in fossil fuels. So even with energy security, there are probably investment organizations that are debating to what degree they can put fossil fuels into an energy transition strategy. And you could argue that to some extent that makes sense. Many years ago, I was involved in a power plant financing in Bangladesh, and people were asking me, why are you going for a gas-fired power plant? Why are you not going for solar? And Bangladesh, at the time, one of the poorest countries, they're doing a lot better today, actually, relatively speaking, but still a very poor country with a lot of flooding issues. I mean, you can't just take a poor country and ask them to go 100% renewable from one day to the next, right? So there are elements of energy transition that I think is relevant. And if it's natural gas as opposed to coal, that's an improvement. Our own focus with ClimateRock is not that market, but I can see relevance in thinking energy transition so that we are not just ignoring the fact that we need to have this energy security addressed. And the world is becoming probably deglobalized to some extent now, which back to your point about other energy sources, whether it's green hydrogen or whether it's batteries, and creating local supply chains or regional supply chains to become more independent and with that increase energy security.
This podcast is brought to you by Accelerate, one of Canada's leading alternative investment solution providers. Do you want to hedge your investment portfolio and protect your nest egg from significant drawdowns? Look no further than the Accelerate Absolute Return Hedge Fund, a long-short equity ETF that trades under the ticker symbol HEDGE, HDGE, on the TSX. HEDGE, your uncorrelated portfolio diversifier. Find out more at accelerateshares.com.
And so where do you see the current ESG driven theme of investing fall short? You'd mentioned some of the themes that you're seeing in energy transition and things of that nature. But what other changes would you like to see in the sector?
Well, I think we will probably like to see some more, let's call it product innovation. I think we're going for same level of efficiency in solar as we've done for the past decade, more or less. I know people in the sector would say that there are some improvements, but there's no revolution going on at the moment. It's all sort of a slow evolution of efficiency of photovoltaic panels. Inverters, which is another component of solar, are improving in efficiencies. But maybe we need to look at new materials as opposed to silicon to try to really improve the panel efficiencies. In solar, you'd probably like to see much more solar on buildings. Why not integrate photovoltaic with windows, where you have so much building that is vertical in big cities? I think there's a massive opportunity in the solar market to grow in many dimensions. Wind, a lot of growth offshore with turbines getting bigger and bigger. But you can't just continue to build bigger and bigger. You probably need to look at other ways of increasing the energy efficiency of the assets so that you actually, by increasing the efficiency of solar and wind, they're already very competitive with fossil fuels. But if you can use this market opportunity to really make them more efficient, then it's almost like there's no way back afterwards. And then I think the growth of the green hydrogen market, which is a market that there's a lot of buzz around. That is a market that's been around for a long time, and you have a lot of companies, whether it's US or Europe, that's been around for some time with technologies in green hydrogen. But the core component of green hydrogen hasn't really developed much over the past decade. So there you also need to look at what's the next generation of the so-called electrolyzers used in green hydrogen, and the balance of plant distribution of the gas. I think these are certainly aspects where the sector will improve. ESG is not really for me to comment on. ESG is a terminology that was introduced to make investors more aware they have to invest in what is compliant with the environmental and social and governance rules. But ultimately, to me, that's just using best practice. You got to do what you think is right, and ESG is just a way of regulating it.
Now, Per, we spoke of a lot of themes on the show today: solar, wind, nuclear, various clean tech, renewable energy technologies. Now, if you could just pick one, what is one that investors should have on their radar over the next 10 years?
Well, I think I alluded to it already. To me, it's renewable hydrogen. So it's using the growing capacity of renewable energy to power green hydrogen production. Green hydrogen or hydrogen market is actually a significant component of the global energy markets. And there are many industries that are not able to make the full transition into the green economy unless they're also able to transition their hydrogen consumption to green hydrogen from hydrogen or what we call reformed hydrogen from oil and gas. So renewable hydrogen is a massive theme over the next 10 years. That doesn't prevent solar from growing. That doesn't prevent wind from growing. I think you could also see much more development of hydroelectric power. But I think renewable hydrogen is a massive opportunity.
Well, that's a great place to end it. The recommendation of green hydrogen, renewable hydrogen, to keep that on your radar for investors. So thank you, Per, for coming on the show. The SPAC that you're currently managing, ticker symbol CLRC, trading in New York. So investors can take a look into that if they want to follow along all the progress that you're making at ClimateRock. So wishing you the best of success, and we'll be watching the story closely.
Thank you, Julian. Thank you, Michael. Thank you for being on the show.
All right, take care. Bye, everybody.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.